Now we're going to take a look at how do we actually go about starting to actually record these transactions in our various T accounts. Now, a transaction occurs when the business trades something of value with another person or business, and that causes a change in assets, liability, and equity. An event does not involve trading something of value, such as an asset, liability, or equity, are not affected by an event, then nothing is going to be recorded in the T accounts. So the only time we're going to record something in the T account is if the business trades something of value with another person and it causes a change in our assets, liability, or equity. And there might be times where there's an event that takes place, but nothing has happened yet. The ultimate goal of recording business transactions is to be able to create financial statements and to assess how well the business is doing. And we see here a chart at the bottom of slide 37 or 47, and I don't see that here in the book for us. But we see, for example, if we were to purchase a computer, we receive something of value for that and exchanged either a liability for it or cash for it. So then we would have to record that. If we're simply having a discussion with a customer comes in and asks us maybe about the price of something or about setting up something, but they haven't actually done anything yet, then we wouldn't record it. Once they do and they either receive a product or service from us, then we would record it. And then another example would be paying rent. Then we would have to record it. Now, we're going to use an example, a company called Ace Bookkeepers in what we're talking about. So Ace Bookkeepers is a new sole proprietorship that was owned and that was started by John Smith. March of 2023 was their first month in business. We will show how each transaction is recorded in the T accounts, demonstrate how the accounting equation would remain in balance, and then also explain any impact upon the owner's equity. And so we see the first transaction is the owner deposited $30,000 in cash into the business's new bank account. So he is taking his money that he has and he's now investing that into his business. So we would debit cash in the amount of $30,000 because we're now increasing that in our bank account, and we're going to credit Smith Capital $30,000 in order to record the capital that he has. And so we see there we went up in assets and also went up in capital. So our equation remains balanced. And the impact on our owner's equity is that we had an increase because of the owner's investment. Now, also, Ace Bookkeepers, they also borrowed $10,000 from the bank. And so in this case, we would debit cash in the amount of $10,000 in order to show the increase in cash. We would have to credit notes payable $10,000 because we've incurred a liability. Now notice that what we do on one side, we have to do the opposite to the other, or reflect it also on the other side. So we increased assets of $10,000. We also increased our liability of $10,000. And so there's no impact on owner's equity because this didn't affect that. It went an asset and a liability. So now with that, Ace Bookkeepers bought $8,000 worth of furniture with cash. So we would debit cash in the amount of $8,000 because we received, I debit furniture in the amount of $8,000 because we received the furniture, and we would credit cash $8,000 because we paid out cash. And we see we minused cash, went up an asset, so that it just basically is a wash. We just exchanged one asset for another, and there was no impact on owner's equity. A customer paid $2,000 cash for bookkeeping services that's to be performed next month. So we would debit cash in the amount of $2,000 because we went up in cash. And we would credit unearned revenue $2,000 because we have that liability of $2,000 worth of work to our customer. And we see that we went up in assets. We also went up in liabilities, and we haven't done any work yet, so we don't have any impact on owner's equity. Now, once transaction number 5 is ACE bookkeepers provided services to customers and received $15,000 in cash. Well, we would debit cash in the amount of $15,000 in order to show the cash that was received. We would credit our service revenue $15,000 in order to show now the revenue that we've earned. And that affects our owner's equity because we've now earned revenue. We've now done work for that. Now, ACE bookkeepers provided $4,000 of services on account. So we've done service for somebody. They haven't paid us, but they're promising that they're going to pay us at a later time. So we would debit accounts receivable or AR $4,000 because that's an asset because we're owed that money. And then we're going to credit service revenue for $4,000 in order to recognize the revenue that we've earned because we've done the work for that. And so that increases our owner's equity by $4,000. And then finally, or I don't know about finally, but ACE bookkeepers paid $6,000 in cash for a 1-year insurance policy, and that starts the 1st of next month. So we would debit debit prepaid insurance $6,000 to show the payment of insurance, and now we have an asset of insurance. And we would credit cash $6,000 in order to reduce cash by the amount that we paid. And so basically, you say it's a wash on our assets, and so there's no impact on that. And so we see here kind of the breakdown of how all of that is, or some different transactions here that are kind of similar. So ACE bookkeepers paid $1,100 in cash for rent. They paid $6,000 to employees in salary and $200 of cash on interest to the bank. And so we would credit cash for each one of those because we're paying out cash for each one of those. We would debit the respective expenses for those to show an increase on the expenses. And that reduces our owner's equity. And then ACE bookkeepers received a phone bill for $300, which they're going to pay later. And then they also paid travel expenses of $2,000 on a credit with using a credit card that they're going to pay next month. And so we would debit those expenses to show those expenses that have been incurred, and then we would credit accounts payable for those in order to increase on the liabilities. And that decreases our owner's equity because we incurred those expenses. And then ACE bookkeeping paid $3,000 towards the bank loan. So we would debit notes payable $3,000 to reduce the amount of the debt for the bank loan. We would credit cash $3,000 to show cash going out, and this doesn't affect equity. And then the owner took out $2,000 in cash for personal use. Now, in a sole proprietorship, the owner is not an employee of the business, and therefore they don't receive a salary the way that an employee would. And so in this case, the owner would be compensated in the form of cash withdrawal from the business. So for a sole proprietorship, that's how it is. Obviously, if it's set up as a corporation, as an S Corp, as a C Corp, as an LLC, something else, then it could be that the owner is paid just as an employee would be. But in this case, the owner gets paid by taking out withdrawals from equity from the business. So we would debit Smith withdrawals to decrease his equity position, and then we would credit cash for $2,000 to show the amount of cash that was paid. And then on transaction 15, we see that a customer paid $500 in cash for an amount that they owed for service that they had been provided earlier in the month. So we would debit cash for $500 to show the cash coming in. We would credit accounts receivable $500 to reduce the amount of accounts receivable. So again, it's just a wash. There's no impact on equity. And then we paid, Ace Bookkeepers paid the phone bill that was received earlier in the month. So we would debit accounts payable to show the reduction in accounts payable to what we're owing. And then we would credit cash in the amount of 300 to show the payment of cash. Which transaction would result in an increase in cash and an increase in owner's equity? Would it be A, that we borrowed money from the bank? Would it be that the owner deposited cash into the business? Is it that the received a cash deposit from a customer for a service that hasn't been performed yet, or we invested in a new manufacturing plant? In this case, it would be the owner deposited cash into the business because the owner's equity would increase as well as the amount of cash in our bank would increase.